Hi, I'm Ginger Chen, founder of WealthQuant. We work as financial and tax strategists, and our focus is on education, modeling, and strategic design, helping clients connect income planning, investment considerations, and tax planning into one cohesive system instead of treating each decision in silos. Before we continue, just a quick clarification. This session is for educational purposes only. Nothing discussed here is tax, legal, or investment advice. At WealthQuant, we do not provide tax or investment advice. We design and evaluate strategies, perform modeling and analysis, and coordinate with licensed professionals such as CPAs and attorneys for verification and execution. All examples shared are illustrative only. Actual outcomes will depend on individual circumstances, eligibility, timing, structure, and the applicable tax law at the time. So, renewable energy isn't just trending anymore, it's accelerating fast. EV adoption is at an all-time high, and we're seeing solar projects scale across homes, businesses, and entire utility systems nationwide. A lot of that momentum started with the 2022 Inflation Reduction Act, which unleashed some of the most powerful clean energy incentives we've ever seen in the US. That's a huge reason EV charging projects have become a serious target for both individual investors and big institutions. When structured properly, they can meaningfully boost after-tax income by combining project revenue, federal incentives, and accelerated depreciation, often across salary, RSUs, bonuses, business income, and even capital gains. So in this video, we're going to break down how EV charging investments actually work, what the financial benefits look like under the current law, the risks and realities you need to understand, and how people actually get into these projects. And then we'll walk you through a real-world example so you can see the numbers for yourself. Just like solar, EV charging projects are something you've probably seen everywhere by now. In 2025, they're hard to miss. You pull into a mall, a big box retailer, or pretty much any large commercial parking lot, and you'll see them. You see sleek EV charging stations lined up near the entrance, letting drivers top up their cars while they shop. And here's the interesting part. These stations aren't just convenient for drivers. They're profitable for the people who own them too. They generate real recurring revenue. And on top of that, they come with powerful tax advantages that make the economics even stronger. Purchasing EV projects offers three major benefits. The first one is investment tax credits, also known as ITC. A tax credit reduces your tax bill dollar for dollar. Think of it like a credit applied directly against what you owe, almost like having a store gift card for your taxes. For example, if you owe $1,000 in taxes and you have a $600 tax credit, you don't owe $1,000 anymore. Your tax bill drops to $400. The government uses tax credits to encourage certain behaviors and investments. And in recent years, credits tied to renewable energy have become some of the most powerful tax tools available, which is the reason why they became so widely used in wealth and tax strategy planning. The second benefit for EV charging projects is depreciation. Depreciation represents the decline in value of a physical asset over time. From a tax perspective, that matters because you may be able to deduct that depreciable amount, which lowers your taxable income and reduces your tax bill. EV charging projects are treated like other business assets for tax purposes, which means they generally qualify for bonus depreciation. And under current rules, that often allows owners to deduct a substantial portion, and in some cases, nearly the entire project value in the first year, subject to certain technical limitations. The third benefit of EV charging project is income stream. Every time someone pays to charge, the owner earns revenue, usually under long-term agreements that run about 20 years. And returns vary based on the location, the usage, and energy pricing. But many projects tend to produce anywhere around 1 to 5% a year relative to the original purchase price. Now that we've covered the benefits of EV charging projects, let's talk about how these deals are typically structured. Most EV charging investments are set up as an asset purchase. That means the company that develops and installs the charger sells the project directly to the buyer, usually a high-income individual or business looking to reduce taxes. By owning the asset outright, the purchaser receives the tax incentives and the income generated from charging activity while keeping ongoing involvement relatively light. Operations and maintenance are usually handled by a professional third-party provider, although owners technically have the option to manage the project themselves. Meanwhile, the developer is compensated through agreements with the site host, often referred to as the off-taker, such as a shopping center and hotel or commercial property. So this structure gives the buyer the upside of tax benefits and long-term cash flow, but it also means they're ultimately responsible for ownership, administration, compliance, etc. So in practice, most of that is outsourced. So it isn't really an operational burden, but it is still true ownership when you purchase an EV charging project. Now that you know about EV charging projects, who is this really for? EV charging projects tend to be an excellent fit for individuals or businesses looking to offset $500,000 or more in annual taxable income. They're especially well suited for those who want full ownership of a real asset, along with control over the economics, while still being able to delegate the day-to-day management to professionals. And what are the financial benefits associated with these? Well, we talked about it. One is tax benefit. The purchaser receives available tax credits and depreciation from the EV project. And in many well-structured projects, that can translate to roughly $1.45 in tax savings for every $1 invested, depending on the investor's tax situation and applicable tax rules. And it also provides stable income. In addition to tax advantages, the buyer also receives a share of the project's annual charging revenue. This creates a steady income stream, typically around 5 cents per year for every dollar invested, subject to location, usage, and project performance, of course. While EV charging projects can offer meaningful financial and tax advantages, it's important to clearly understand the requirements, the risks, the limitations also before moving forward. The first risk is material participation requirements. For tax purposes, the IRS basically puts your income into 2 buckets. Active income bucket, like your W-2 salary or business you actually run, and passive income bucket, like rental income or investments you're not really managing. And here's the key rule. Active losses offset active income, and passive losses offset passive income. They normally don't mix the buckets. And EV charging projects work the exact same way. If you want to use the tax benefits from an EV project to offset your active income, then you need to actually be active in the EV business. And that usually means you need to set up an LLC to own the project. And then you need to materially participate in an EV business, which generally means spending over 100 hours a year doing real meaningful work in a business, not just signing papers, and being at least as involved as anyone else involved in the project. So here's where it gets a bit gray. The IRS hasn't clearly defined what counts as material work in the EV space. So there's not a perfect checklist. But if you work with any experienced accounting firms, CPAs, they tend to give you the same guidance. Treat your EV project like a real business. Be involved, do things that actually matter, and document everything. Another risk is developer and project execution risk. To qualify for credits and depreciation in a given year, the charger generally needs to be mechanically complete. They generally need to be placed in service in that same year. So you're usually buying new projects, not something that's already been running for years. Once it goes live, the project generally needs to stay operational for at least 5 years and 1 day, or the IRS can claw back part of the credit. So what should you look for? Well, you should look for realistic project timelines, a developer with a real track record, and clear plans to keep the station operating long term. Last but not the least, there's also limits on depreciation and credits. If you're trying to use depreciation against W-2 income, there is a limit called the excess business loss rule. Roughly speaking, that caps depreciation at about $313,000 per person or $626,000 per married couple per year for 2025. Anything above that usually just rolls forward to future years. So if you're a business owner like a C Corp with the business income, that cap generally doesn't count. Tax credits work differently. Typically, you can use credits to cover up to 75% of your remaining federal tax bill after depreciation is taken. And whatever you don't use usually carries forward for many, many years. So now that you have a general understanding of how EV projects work, we can walk through what this actually looks like in real life with an example. So meet Tom. He's a tech executive in California, earning $3 million in 2025. With that level of income, he's staring at a big tax bill, about $1.51 million between federal and California taxes. After writing that check, he'd keep roughly $1.49 million. Now, here's where things get interesting. If Tom buys an EV charging project, he can use the available tax credits and depreciation to dramatically reduce that tax bill and still get an income stream from the project. Let's say he invests $300,000 into an EV project in 2025. With the way credits and depreciation work, he could bring his total taxes down from $1.509 million to roughly $1.08 million in the first year. And he may see additional state savings in future years. And here's how that breaks down mathematically. Around 199,800 tax credits in year one, which is about 67% of the original investment, and around $209,457 in federal depreciation, or about 70% of the original investment, assuming top federal rates. And he gets about 88,578 total in state depreciation, with part of that available in year one and the rest spread over several years. So credits and depreciation do have rules and limits, but the key point is this. Anything he can't use right away typically carries forward so that nothing is wasted. On top of the tax benefits, the EV projects also pays in ongoing income. So many projects distribute around 1% per year. So on a $300,000 investment, that's roughly $3,000 per year, or around $18,000 over 6 years. The actual numbers will depend on the performance, the usage, but that kind of gives you a realistic picture. And here's the important perspective shift. That $300,000 invested in EV charging project isn't competing with the stock market. It's not money that he would have invested anyways. It's the money that he would have paid to the IRS and never seen again. So instead, he redirects those tax dollars into a real asset that creates meaningful tax savings, generates long-term income, and he establishes an investment in renewable infrastructure. So when someone tries to compare this directly to investing after-tax dollars in the market, it's not really comparing apples to apples. This is about putting pre-tax dollars to work instead of losing them entirely to taxes. Purchasing EV charging projects can be a smart strategy for high-income earners who are looking for meaningful ways to reduce taxes while putting their money towards something productive. So how do you actually get access to qualified projects? The good news is it's not complicated. WealthQuant works with experienced, reputable developers, which makes it much easier to find projects that are legitimate, well-structured, and aligned with current tax rules. So we'll help you review opportunities, compare options, and understand the potential tax savings and income impact. And we don't do this in a vacuum. We work alongside your CPA. Or if you prefer, we can collaborate with our CPA partners who have deep experience in renewable energy tax strategies. And from there, we'll walk you through the process step by step so your purchase is seamless and confident. If you want to see whether EV projects might make sense for your situation, then just book a discovery call with us. We'll look at your goals, your financial profile, and whether the strategy truly fits what you're trying to accomplish.